while banks typically don't. Collateral is an asset that the lender can seize if you fail to repay the loan. There are two paths in life, the righty path and the lefty path. They both start at the same place, but they lead to different destinations. Just like our two farmers who both need $1,000. One farmer chooses the righty path. The other chooses the lefty path. Where will they end up? Let's find out. Hello and welcome back to our Microfinance series, where we demystify all things microfinance and help you make more informed financial decisions. Today, we are comparing two ways of borrowing money: microfinance and bank loans. We hope that by the end of this episode, you will be able to figure out which option is best for you. Our story features two farmers. Both farmers need $1,000 for their crops. The first farmer, let's call him Farmer A, goes to a microfinance institution to get the money. The second farmer, let's call him Farmer B, decides to go to the bank instead. He visits his local bank manager and applies for a loan of $1,000. The bank manager tells him that it might take a few days to process his loan application, but Farmer B is patient. He understands that the bank needs to check his creditworthiness before approving his loan. After 3 days, the bank manager contacts Farmer B and informs him that his loan has been approved. Farmer B is overjoyed and accepts the loan. He knows that he'll have to pay back the loan in 12 monthly installments of $86 each. But there's no additional interest charged. By the time he pays off his loan, Farmer B would have paid $1,032. Farmer B is relieved that he didn't have to pay any extra interest and is happy with his decision to go to the bank. Okay, so what did we learn from our story? Let's look at some key points. Firstly, getting a loan from a microfinance institution is much faster than going through the traditional banking system. With MFIs, you can often get approved for a loan in a matter of days or even hours. Banks, on the other hand, may take several weeks or even months to process your loan application. This is because banks have stricter requirements and more extensive checks to determine your creditworthiness. Secondly, interest rates are generally lower when you borrow from a bank compared to an MFI. Banks typically have access to a larger pool of funds and can offer more competitive interest rates. MFIs, on the other hand, may charge higher interest rates due to the increased risk associated with lending to individuals with limited credit histories or low incomes. Thirdly, banks usually offer larger loan amounts compared to MFIs. This is because banks see borrowers as less risky and therefore are willing to lend them larger sums of money. MFIs, on the other hand, may have smaller loan limits as they cater to individuals who may not have access to traditional banking services or have limited credit histories. Fourthly, MFIs often require collateral for loans, while banks typically don't. Collateral is an asset that the lender can seize if you fail to repay the loan. MFIs may accept personal property or a cosigner as collateral, while banks may not require any collateral at all, depending on the amount of the loan and your credit history. Finally, both MFIs and banks have their own advantages and disadvantages. The choice between the two depends on various factors such as the purpose of the loan, the amount of money needed, your income, and credit history. Let's recap the story of our two farmers. Farmer A chose to go with an MFI and ended up paying $1,260 by the time he paid off his loan. On the other hand, Farmer B went with the bank and only paid $1,032 by the time he paid off his loan. Even though Farmer A had to pay more money overall, he was able to get the money much faster. And did I have to wait for his application to be processed? Additionally, he didn't have to meet strict eligibility requirements set by the bank. Farmer B, on the other hand, had to wait longer for his loan to be approved, but he ultimately saved money by choosing the bank over the MFI. So, which option would you choose? Would you rather go with the MFI and get the money quickly, or would you prefer to go with the bank and save money on interest? Let us know in the comments below. In general, MFIs tend to be more flexible than banks when it comes to credit history and collateral requirements. This means that individuals who may not have a credit history or have limited access to collateral may still be able to obtain a loan from an MFI. Additionally, MFIs often have shorter loan repayment periods, which can be beneficial for borrowers who need access to credit for a short period of time. Banks, on the other hand, typically offer lower interest rates and larger loan amounts. This makes them a more attractive option for borrowers who are looking to finance a larger purchase or need access to a larger line of credit. Banks also typically have more sophisticated loan products and services, such as different types of mortgages or lines of credit. These products can be beneficial for borrowers who need a more customized or flexible loan solution. Ultimately, the best option for you will depend on your specific circumstances and needs. If you need money quickly and have a limited credit history, then an MFI may be a better option. If you're looking to save money on interest and have a good credit history, then a bank may be a better option. Now, let's take a look at a side-by-side chart that compares microfinance and bank loans. This chart will help you see the main differences between these two types of loans and hopefully help you decide which one is right for you. Let's start with the speed of approval. As we mentioned earlier, loans from MFIs are typically approved much faster than those from banks. This is because MFIs have less stringent requirements and typically have shorter processing times. On the other hand, bank loans can take weeks or even months to approve. This is due to the more extensive checks and verifications that banks require. Next, let's look at the interest rates. Bank loans typically have lower interest rates compared to MFI loans. This is because banks have access to a larger pool of funds and typically have lower overhead costs, which allows them to pass on lower interest rates to their customers. However, it's important to note that the specific interest rate you'll pay will depend on your creditworthiness. Those with a poor credit history may end up with higher interest rates regardless of whether they borrow from a bank or an MFI. Another important factor to consider is the loan amount. As we mentioned earlier, bank loans typically have higher loan amounts compared to MFI loans. This is because banks view borrowers as less risky and therefore are willing to lend them larger sums of money. Next, let's talk about collateral requirements. MFIs typically require some form of collateral, such as personal property or a cosigner, whereas banks may not require any collateral at all, depending on the amount of the loan and your credit history. Finally, let's discuss the repayment terms. MFI loans typically have shorter repayment periods compared to bank loans. This can be beneficial for borrowers who need access to credit for a short period of time. However, it's important to note that shorter repayment periods typically result in higher monthly payments. Bank loans, on the other hand, typically have longer repayment periods, which can result in lower monthly payments. However, it's important to keep in mind the total amount of interest you'll pay over the life of the loan. We created a simple example loan repayment table to illustrate the difference between an MFI and a bank loan. Let's say you borrow $1,000 from an MFI with an annual interest rate of 12% and a repayment period of 12 months. Your monthly installment would be around $92. However, by the end of the loan term, you would have paid a total of $1,140, which is an extra $140 just an interest expense. Now, let's compare this to a bank loan for the same amount, interest rate and repayment period. The monthly installment would be around $86, which is $6 less than the MFI. And by the end of the loan term, you would have paid a total of $1,032, which is $78 less than the MFI option. This shows that while the monthly installment is slightly higher with the bank loan, you'll end up paying significantly less overall due to the lower interest rate. So, which do you prefer, bank or MFI? Comment below and let us know. Both microfinance and bank loans can be valuable tools for individuals who need access to credit. However, it's important to carefully consider your options and choose wisely based on your specific circumstances and needs. Don't just focus on the interest rate or the loan amount. Take into account the repayment terms eligibility requirements, and other factors to determine which option is right for you by taking the time to evaluate your options. You can make an informed decision that will help you achieve your financial goals without falling into a debt trap. Thank you for joining us for today's episode on Microfinance. We hope you found it informative and helpful. If you're interested in learning more about microfinance, be sure to subscribe to our channel and hit the notification bell to stay updated on our latest videos. You can also leave a comment below with any questions or suggestions you have for future episodes. Thanks for watching, and see you next time.